Everyone, welcome back to my YouTube channel Manuishu ACCA classes, and I am again back with the video on the past paper, and this is for all the PM student. So question name is Hammer Co. So there is four requirement of this question, and question total marks is 20. So first question, they're asking calculate the price that Nail would charge for the garden shares under the existing policy of variable cost plus 30%. Then this next question, they have asked calculate the increase or decrease in the price if the pricing policy switched to the total cost plus 10%. And the third one is discuss whether or not including the fixed cost in the transfer price is sensible policy. And the last, discuss whether the retail stores should be allowed to buy in from outside supplier if the price are cheaper than those charged by nil. So combination of pricing policy, transfer pricing. So all these topics I think have been covered in this question. So let's have a background about the question. The question is asking, Hammer is a large garden equipment supplier with retail stores throughout the two land. So company is large garden equipment supplier. Many of these products itself are bought in from outside supplier, but some are currently manufactured by Hammer on manufacturing division Nail. So some of the part has been bought by from the outside supplier, and some of them is been manufactured inside the organization. The price or transfer price that Nail charges to the retail stores are set by head office and have been subject of some discussion. The current policy is for the Nail to calculate the total variable cost of production and deliver and at 30% of the profit. See, so basically the price that Nail, the division who is manufacturing some of the component inside the organization, the transfer price that division will charge to the retail store are set by the head office. So centralized. So basically they are centralized. Decision making system, and has been subject of some of discussion. So current policy that this division is operating, the current policy is to have total variable cost of production, then add 30% of the profit. See, this is a markup. Why? Because we are adding it on the cost, not on the selling price. Snell argued that all costs should be taken into consideration, offering to reduce the markup cost to 10%. In this case, the retail stores are unhappy with the current pricing policy, arguing that it results in the prices that are often higher than comparable product available on the market. Sunil has provided the following information to enable the price comparison to be made of two possible pricing policy for one of its product. So garden shares steel, the shares have 0.4 kg of high quality steel in the final product. The manufacturing process loses 5% of steel put in. Steel cost 4,000 per ton. 1 ton equal to 1000 kg. Other materials are bought in and have a list price of 3 per kg, although Hammer secures a 10% volume discount on all purchases. The sale requires 0.1 kg of these materials. Labor time to produce shares is 0.25 hours per unit, and the labor cost $10 per hour. Variable overhead are absorbed at the rate of 150% of the labor rate, and the fixed overhead are 80% of the variable overhead. Delivery is made by an outsourced distributor that charges the Nail 0.50 per garden share for the delivery. Okay. So they have provided the material, how much quantity being used, and their prices, everything they have been provided. So first question, that is their requirement A. Okay, so in this question is asking to calculate the price that nails the division should be charged for the garden shares under the existing policy, that is the variable cost plus 30%. See, here question asks you to calculate. So if you are describing anything, you won't get the credit because the question specifically asks to calculate. So what is the existing policy? The existing policy is that is your total variable cost plus 30%, right? So first thing that we need to figure it out, what is the total variable cost, okay, for the garden shares. So here they have provided the details. So first is the steel. Okay, so how much steel being used? So basically, the shares have 0.4. The question said 0.4 kg of high quality steel in his final product, right? But while manufacturing, 5% get lost. So if we need, suppose if we need 0.4 kg of like material, it means it is 95%. 5% being lost, so we need to consider the 100%. And how can we calculate the 100%? Simply we will divide this by 95%. That means 100 divided by 95. Okay, so we will get 95% for this. And what is the cost? It's 4,000 per ton. So but we are not using the ton, we are using in the kg, you can see here. So we need to divide it by 1000 in order to get in the kg. So alt is 0, sorry, alt h 0, sorry, alt is 9. um, yeah, so it is 1.68. Okay, so basically what happens, see, for manufacturing the garden chairs, so 0.4 kg of steel is required, 0.4 kg of, but this steel is only 95%. Why? Because 5% get lost while manufacturing. So that means we need to keep extra 5% in order, so that we will get the final output as 0.4 kg. So that's why I have just grossed it up to the 100% because it is only 95%. So we need to add 5% for loss as well. So that's why I have multiplied it by 100 and divide it by 95. Again, we need to add the price as well, which is 4,000 per ton, but the quantity we are using is in the kg. So in order to convert this stone into kg, I have divided it by thousands. So we will get the per kg, it's 4, and for 1000 kg it will be 4,000. So by doing that, I got this steel value as 1.68. So other is your other materials. Okay, so other materials are bought in have a list price of 3 per kg. So list price is 3 per kg. Hammer secures 10% volume discount on its all purchase. So as the hammer is getting discount, so it means it is, we will only take the 90% here, and she requires 0.1 kg of this material. So that means again we need to multiply with 0.1. So again this will be in the your dollar per kg. All right. Now labor. Labor labor is 0.25 hours per unit. So basically this is not the kg, it's per unit. For 1 unit we are calculating, right? It's my fault. Yeah. So now for labor, how much we are paying labor for per hour? 10, right? And how many hours we require to produce one garden share is 0.25. So we need to multiply it by 0.25. Okay, and again this is for the per unit. And then we have a variable overhead. Variable overhead, which is 150% of the labor. So how much labor is 2.50 and we will multiply with 150 percentage. This will give 3.75. Okay, so now last is your delivery. Delivery is your 0.50 per garden delivers, 0.50 for per unit. Okay, so this is all the variable cost involved for the production of the garden chairs. So if we will add this, how much it will be? Okay, so it is 8.70. This is the only total variable cost. Okay, so this is your total variable cost. Now the question asks the pricing to be 30. We need to add extra 30% on this variable cost. So we will take this into 1.3. So this will give you alt H9. Okay, so this will give the total pricing of 11.32. Okay, so this is for the our requirement one. See, only for this 6 marks has been allocated. So if you will perform very well in this part, you will get 6 mark very easily. Okay, now now for uh, requirement B. Now the comment B. So what is that? Calculate the increase or decrease in price if the pricing policy switch to the total cost plus 10%. Alright. So everything will be same as we have done earlier. So let me copy paste this. Now existing what is the pricing policy? Pricing is equal to your total cost plus 10%. So that means we need to first find the total cost. Okay. So we got the total variable cost. Now anything else that we have been left to do? Yes, one more thing that we have been left to do is fixed overhead. Earlier we didn't consider this, but now we will consider this as well because question has told to calculate the price having total cost plus 10%. So now your fixed overhead is equal to how much? 80% of the variable overhead. So 80% of the variable overhead. So our total variable cost is 8.70. 80% is 6.96. Sorry, it's my fault. So basically variable overhead. Variable overhead is our this one 3.75. So we will take 80% of this amount, not the total variable cost. So this is our fixed overhead cost. Now we have to find out the total cost, right? Okay, so this is the 11.70 total cost. Now we need to calculate the pricing. And how can we calculate the pricing? So it's 10% more than this amount, so 1.1. So this one is the your pricing according to the total cost plus 10%. Okay. But the question B didn't ask you to calculate on the price, but they have also asked you to calculate the increase or decrease in the price. So now you can see whether the price has been decreased or increased. So price difference. So basically price has been increased by how much? 1.56. And this is dollar per unit, and you can write in the bracket increases. So this is the way you should present your answer. Okay. Okay. Now let's move to the section C. I mean question C. The question is asking, discuss whether or not including the fixed cost in transfer pricing is sensible policy. So this one is your requirement C. Okay. So what you can write is, discuss the both part, whether or not, because question asks whether or not including fixed cost in transfer price is sensible policy. So it depends on the circumstances, right? So whether to include the fixed cost in the transfer price or not. So basically, what do you mean by fixed cost? Fixed cost are those costs that do not vary with the level of productions, right? So an example could be your depreciation, rent, right? So this cost must be incurred regardless of the number of units produced or sold by an organization. So when we are setting the transfer price, company must consider both of the cost, like that is a variable as well as the fixed cost, which have been incurred while producing the unit. But including the fixed cost in transfer price will result in that selling division covers its fair share of the company overall cost and contribute to the company overall profitability. But at the same time, other, if we want to discuss over the other part, that is not to include in the transfer price. Why? Because it can result in the price being higher, which may make it difficult for the buying division to compete it in the external market, right? So it can create a disincentive for the selling division to lower its fixed cost, as these costs are already covered by the our transfer pricing. So you need to discuss the both of this part, and this is only for the 4 marks. Try it from your end and let me know in case you need my any help. Now fourth question is, discuss whether the retail store should be allowed to buy in from outside supplier if the prices are cheaper than those charged by the nail. See, before making any decision, it is very important to consider the few factors like your transfer pricing, right? So, if current transfer price, I mean, we need to review first the transfer pricing policy. So if the retail stores are allowed to buy from the outside supplier, so in that case, if nail is charging higher price to the retail store, it may need to reduce their transfer price to remain competitive in the market. Other is like your long term impact. Switching to the outside supplier may have a long term impact on the relationship between your the nail division and the retail stores. So if nail perceives that the retail stores as being disloyal or not supporting its product, so this may lead to the store, this may lead to the strain the relationship between these two party. So it will harm the overall performance of the organization. And the third thing that we need to ensure regarding the quality, because it is very important, we need it is very important to ensure the quality of the product that is being offered by the outside supplier as compared to the that has been manufactured by our nail division. So poor quality may again lead to the harm to our reputation of the organization, and that could also result in the loss of sales, right? So if you want me to write this point, you can write in this way. Let me first write for the part C. What the question asks, to including, okay, including the fixed cost in a transfer price may or may not be sensible policy. So it depends on the specific circumstances. Okay, so fixed costs are those costs that do not vary with the level of production. So these costs must must be this cost will incurred anyhow regardless of the number of being units being produced by the organization. See, when you are writing your answer in the exam, please don't write the whole paragraph in the one cell. It don't look professional. So what you can write it, you can write a one line as shown in my screen, and then you can move to the next cell. Again, you can once this line is complete, then you can move to the other cell. So whatever the portion that will reflect over your screen, you should only write or include those words in that particular cell. Okay, so it will look more better rather than adding all the word in the same cell. Okay, so this cost will incur anyhow regardless of the number of units being produced by the organization. So when fixed cost fixed cost is included in the transfer price, no, or what we can write is um, when company is setting the transfer price, then company should consider both fixed cost as well as variable cost, which are incurred while producing the units, right? Because including the fixed cost in the transfer price ensures that division who are selling the product covers the overall cost of the product and it will also contribute towards the profitability. So you can write like this, okay? Then we will also talk other part of the like not including the fixed cost. However, if we are including the fixed cost in the transfer fixed cost while setting the transfer pricing, there are few cons for the same. That means few drawback for the same, including the fixed cost will make it difficult for the buying division to compete in the external market. Okay, So this is a way you can write for this requirement. I have talked from the both of the perspective, like from seller division as well as the from the buying division. Now moving to the part D. So for part D, okay. So question asks like, what is the factor that we need? I mean, whether retail stores should be allowed to buy from the outside supplier if prices are cheaper than those charged by nail or not, right? So again, we will talk from the both perspective. So the retail stores should be allowed. No. Before buying from the outside suppliers, retail stores should consider few factors. And what are those factors? Like first thing that need to consider is price. Okay? What we can write in this price? For the price we can write price. Okay. So if the outside suppliers is selling the same products at the cheaper rate, then current transfer pricing policy of the nail division may need to be reviewed. If the nail is charging higher price as compared to the outside suppliers, it may need to consider to reduce the transfer price in order to remain competitive in the market. Okay, so this is the way you can present your answer. And for again, what other factor we can consider? Yeah, quality. Regarding the quality, so again, before buying from the outside suppliers, retail stores also need to ensure the quality of the goods. It might be possible at the lower price they may be providing the lower quality goods. Poor quality may lead to harm our reputation or goodwill, that may lead to reduction in sales as well as loss of customers. Okay, so this is the way you can write, and you can also mention one more point regarding the long term impact, because if we are switching to the outside supplier, again it may impact in the long term. Why? Because the relation between the internal division will be no more good, so we need to consider that factor as well. So this is the way you can present your answer. I hope you have enjoyed. So thank you so much guys for watching this video. Have a good day.